Welcome to AI-assisted earnings call analysis. All Dreamfolks Services Limited. Quarter 3 fiscal year 2024-25. Management update on quarter 3 progress. Air traffic and credit card growth drove revenue. Stable gross margins despite increased spending thresholds. Investments in talent and new services contribute to future growth. Diversified portfolio including airlines, lounges, and golf courses. Growing bank client base due to positive customer experience. Focus on long-term growth across services, clientele, and geography. Expanded by offering baggage wrapping service. Domestic market dominance with 76% share. Partnerships with travel agencies and loyalty programs. Global footprint with 380-plus airport terminals served. In-house proprietary technology platform for personalized user experience. Increased revenue and profitability in recent quarters. Positive financial performance reflected in net worth and cash flow. Quarter 3 financial summary. Revenue increased by 11.5% year-over-year to Rs 340.1 crore in Quarter 3 fiscal year 24. Gross profit remained stable at Rs 38.3 crore. Adjusted EBITDA decreased to Rs 25.8 crore down from Rs 29.7 crore. Adjusted EBITDA increased by 0.1 crore from 9 months fiscal year 24, reaching Rs 77.1 crore. Adjusted EBITDA margin decreased by 0.8 percentage point from 9 months fiscal year 24, reaching 7.9%. Margin decreased by 0.8 percentage point from 9 months fiscal year 24, reaching 5.1%. Earnings per share remained stable at Rs 3.2 for 9 months fiscal year 25. Quarter 3 strong points. Air traffic and credit card growth drove revenue. Stable gross margins despite increased spending thresholds. Investments in talent and new services contribute to future growth. Diversified portfolio including new airlines, lounges, and partnerships. Growing bank client base due to positive customer experience. Focus on long-term growth across services, clientele, and geography. Technology platform enhancing user experience and providing transparent information. Robust infrastructure with strategic partnerships for airport expansions. Dedicated team committed to delivering consistent service quality. Expanding service offerings beyond into airport lounges. Secure partnerships with travel agencies and loyalty programs. Global expansion with new lounges and F&B outlets. Emphasis on building a legacy of excellence and customer satisfaction. High financial performance reflecting commitment and positive impact. Increased cash flow from operations and net worth. Continued pursuit of global expansion strategies. Quarter 3 weak points. Increased competition within the market. Challenges associated with managing large volumes of customers. Fluctuations in gross margins due to changes in spending thresholds. Limited availability of skilled labor in some areas. Competition from similar businesses operating internationally. Dependence on external factors such as economic conditions and political stability. Need for continuous innovation to maintain competitiveness. Lack of diversification in terms of income sources. Difficulty in attracting and retaining top talent. High dependence on credit card transactions for revenue. Management sentiment analysis. The management update provides information about Dreamfolks Services' financial performance and strategic initiatives during the recent quarter. The tone is generally positive and reflects confidence in the company's long-term prospects. Here's why. Financial performance, mentioning revenue growth, gross margin stability, and adjusted EBITDA decline indicates that while there may be some short-term fluctuations, the company remains financially sound. Strategic initiatives, focuses on diversification, technological advancement, and building a legacy of excellence suggest proactive measures aimed at sustained growth and market leadership. Customer experience, emphasis on improving customer experience, including new service offerings and collaborations, points towards a dedication to meeting evolving needs. Expansion plans, mentioning new lounges, partnerships, and growing clientele across different markets signals ambition and optimism regarding future expansion. Overall, the management conveys a message of progress, resilience, and continued commitment to delivering exceptional customer experiences. It leans more towards optimistic than negative sentiments. Q&A analysis. Question. What are the key drivers behind the company's growth beyond airport launches? How does the company envision this segment evolving? How will the company scale and integrate services like baggage wrapping and coffee at mall centers? Answer. The company sees its top-line growth driven by 2 factors. Air traffic growth as a result of increased passenger volume. Growth in the credit card industry. Key takeaways. Top-line growth is primarily driven by air traffic growth and credit card industry growth. Baggage wrapping, coffee, and other mall-based services are considered part of the company's broader strategy but require scaling and integration plans. Airport lounges remain crucial for overall business growth. Credit card industry growth plays a significant role in driving revenue. Q&A analysis. Question summary. The investor asks about Dreamfolks' plan to reach a target of 15%-20% revenue contribution from non-airport business within the next 4 to 5 years. They want clarity on how this will be achieved. Answer summary. Strategy #1. Expanding client base. Focus on acquiring new clients beyond banks, specifically focusing on enterprises. This has been successful with recent additions like 13 new enterprises. Strategy #2. Diversifying service offerings. Move beyond travel lending by offering additional services such as this related to lifestyle golf, coffee shops. This expands opportunities for selling their existing products to larger sponsors. Strategy #3. Global expansion. Leverage technology and proven success in India to expand into markets like Southeast Asia and potentially the Middle East. These regions represent initial phases for international growth. Key takeaways. Dreamfolks aims to achieve a 15%-20% revenue split between airport and non-airport business over the next 4-5 years. Their primary focus is expanding their client base through enterprise acquisition. They aim to diversify their offerings beyond travel lending to include lifestyle services. Q&A analysis. Question summary. The investor wants to understand the economic comparison between food and beverage F&B services offered by Dreamfolks and traditional airport lounge services. Specifically, the investor asks about revenue per transaction and profit margin differences. Answer summary. Unit price for F&B is similar to traditional lounges but can reach up to 60%. Consumers prefer F&B due to greater choices available compared to limited options within traditional lounges. F&B offers cultural experiences as well as diverse cuisines, making them attractive additions to airports globally. Key takeaways. Revenue potential. F&B units offer comparable revenue potential to traditional lounges. Consumer preference. Higher customer acceptance of F&B driven by wider menu selection and culturally immersive experience. Strategic expansion. Dreamfolks actively expands their F&B footprint worldwide to capitalize on this growing market segment. Cultural significance. F&B contributes significantly to creating unique cultural experiences for travelers. Q&A analysis. Question summary. Investors want to understand Dreamfolks' perspective on the potential impact of Priority Pass, a competitor offering airport lounges, on their business. Specifically, investors inquire about the differences between the two companies' models and strategies regarding customer acquisition and retention. Answer summary. Dreamfolks emphasizes that while Priority Pass is a well-established player in the Indian market, the differentiation lies in integrating lounge access directly onto customers' existing credit/debit cards without requiring a separate card. This approach allows Dreamfolks to offer seamless integration and convenience, making it attractive to consumers who prefer a streamlined experience. Dreamfolks believes they are far ahead of competitors due to their focus on digitization, service offerings, and expanding beyond traditional travel solutions into lifestyle segments. They highlight that these factors contribute significantly to their success and lack of concern over threats posed by competitors like Priority Pass. Q&A analysis. Question summary. The investor wants information about the breakdown of Dreamfolks' revenue by its top 5 lounges. The investor asks about potential impacts of competitors GMR and Adani setting up their own lounges on Dreamfolks' business. Answer summary. Dreamfolks doesn't have specific data on individual lounge contributions due to varying customer needs and preferences. Dreamfolks acts as a key driver of traffic to various lounges through partnerships with operators like GMR and Adani. While competitor lounges may emerge, Dreamfolks remains confident in its ability to maintain market share and drive growth within the industry. Key takeaways. Revenue breakdown not available. Dreamfolks cannot disclose detailed breakdowns of revenue by individual lounges due to diverse customer demands. Competitive landscape. Competitors entering the lounge space might pose challenges, but Dreamfolks believes its strong network and strategic partnerships can mitigate risks. Focus on growth. Despite competition, Dreamfolks maintains confidence in continued expansion and success within the growing global airport lounge market. Q&A analysis. Question summary. Investors inquire about Dreamfolks' profit margins and revenue when managing lounges belonging to third parties not affiliated with Adani or GMR. They want clarification on how this differs from their own operations where they manage lounges under their brand. Answer summary. Management clarifies that the business model remains consistent regardless of who owns the lounge. No lounges are directly managed by Dreamfolks, all are operated by third parties. Therefore, the impact on profits and revenue is negligible as Dreamfolks doesn't have control over ownership. Key takeaways. Dreamfolks operates solely through a third-party model. Their profit margins and revenue remain unaffected by the ownership structure of the lounges they operate. Third-party ownership has minimal impact on Dreamfolks' financial performance. Q&A analysis. Question summary. The question asks about how Dreamfolks will handle potential price pressures due to increased dominance of Indigo and Tata Airlines in the Indian domestic market. It also inquires if there's a strategy to manage renegotiation or partnership opportunities within the context of these changes. Answer summary. Management clarifies that their business model isn't dependent on specific airlines, but instead focuses on the overall air traffic growth. They emphasize that regardless of which airline passengers choose, airline or B, they focus on serving the customer and don't see the mergers impacting their operations significantly. Key takeaways. Dreamfolks' business model is independent of individual airline performance. Their primary focus remains on capturing air traffic growth across the board. Mergers among major carriers won't affect their core operational strategies. Customer satisfaction remains paramount for Dreamfolks. Q&A analysis. Question summary. The question asks whether Dreamfolks is concerned about potential competition from future airline lounges being launched in India, especially considering the dominance of Indian carriers like Tata and Indigo with significant market shares. Answer summary. Dreamfolks clarifies that while past airline lounges existed at Air India, Jet Airways, they focused on serving specific customer segments, business/loyalty rather than general public access. They emphasize that the service caters to a broader audience beyond business class travelers. Dreamfolks believes the current trend towards private sector involvement in airport services, including lounges, might lead to fewer overall lounges due to consolidation efforts. In addition, the company highlights that any new airline lounges wouldn't pose a direct threat to Dreamfolks as their model focuses on providing an alternative solution for those seeking convenient airport experiences. Key takeaways. Dreamfolks operates within a different customer segment compared to traditional airline lounges. The focus on wider accessibility makes them less vulnerable to competition from airline-specific lounges. Private sector participation in airport services could result in fewer overall lounges, potentially benefiting Dreamfolks. Competition from airline lounges isn't seen as a threat to Dreamfolks' revenues. Q&A analysis. Question summary. Investors inquire about the difficulties faced by Dreamfolks while expanding its operations outside India. They specifically ask if partnerships with international companies like Priority Pass pose a barrier to growth in these foreign markets. Answer summary. Management acknowledges the existence of established players in both India and overseas markets like Priority Pass. However, they'd emphasize that Dreamfolks is focused on differentiating itself through continuous improvement and adaptation to evolving customer needs. Challenges lie primarily in securing new clients, particularly banks, due to lengthy onboarding processes associated with pre-existing relationships. International expansion efforts involve collaboration with global brand networks, including those involved in airport lounge access services. Key takeaways. Differentiation. Dreamfolks emphasizes its focus on constant innovation and adapting to changing customer demands rather than solely relying on competitive advantage. Onboarding challenges. Securing new clients, particularly banks, presents significant hurdles due to long onboarding periods tied to existing relationships. International expansion strategy. Collaboration with global brand networks, such as those offering airport lounge access services, is underway. Competition. While acknowledging competitors exist globally, Dreamfolks believes their approach doesn't hinder. Q&A analysis. Question. What is the current contribution of enterprises like airlines to Dreamfolks' revenue from airport lounge access facilitation? How is the new membership program performing? Is it similar to Priority Pass? Answer. The company expects its share of enterprise contributions to reach around 20% of their total revenue within the next 4 to 5 years. This growth will improve margins. Key takeaways. Enterprise partnerships contribute significantly to future revenue potential at till to 20%. Membership program adoption is positive, but details about performance remain unclear. Model comparison with Priority Pass is not provided. Margin improvement expected due to increased enterprise partnership revenue. Q&A analysis. Investor question. How much does Dreamfolks rely on banks for its revenue? What about other OTAs, online travel agencies? Is there any information regarding the proportion of customers who use the airport lounge access service? Management answer. Close to 95% of their business comes from banking or networking clients. The remaining 5% comes from other OTAs and enterprises. They do not track the specific percentage breakdown of customer usage for different services. Key takeaways. Dominant revenue source. Banks account for nearly all of Dreamfolks' revenue, around 95%. Limited contribution from other sources. Only a small portion of revenue comes from online travel agencies, OTAs, and enterprises. Focus on business-to-business clients. B2B. Dreamfolks primarily targets businesses rather than individual consumers. Expansion beyond lounges. While lounges remain core, they emphasize offering a wider range of services to existing B2B clientele. No direct customer segmentation data. There isn't readily accessible data on the exact proportions of customers using each service. Q&A analysis. Question summary. The investor wants clarification on the low gross margin observed during the current quarter compared to previous quarters. Answer summary. Banks have been raising spending thresholds for consumers. This has led to a decrease in transaction volumes as seen with one specific example where a bank increased its limit by rupees 35,000 to rupees 75,000 but saw a significant drop in transactions. These changes in banking policies impact the overall volume mix and lead to short-term adjustments in gross margins. Key takeaways. Impact of bank policy changes. Increased spending limits by banks can significantly affect transaction volumes due to higher thresholds. Volume mix shift. Changes in customer behavior driven by policy shifts result in a shift in the volume mix, impacting gross margins. Temporary adjustments. Gross margin fluctuations are often temporary and attributed to the aforementioned volume mix shift caused by changing banking policies. Q&A analysis. Question summary. The investor wants to understand the projected revenue for fiscal year 26. They specifically ask about the anticipated growth rate. Answer summary. Management acknowledges the question regarding future revenue projections. They highlight their strong performance in the current fiscal year 25. They point out that they expect to continue exceeding industry growth rates due to their own robust expansion. They compare their growth with the broader market trends like air traffic and credit card usage. Key takeaways. Strong revenue growth. Dreamfolks continues to deliver high revenue growth, surpassing industry averages. Outperformance expected. Their continued success suggests a positive outlook for fiscal year 26. Industry comparison. They emphasize their superior growth compared to key external factors such as air traffic and credit card utilization. Focus on fiscal year 26 performance. While acknowledging past achievements, the focus shifts towards achieving even stronger results in fiscal year 26. Q&A analysis. Question summary. The investor asks for clarification regarding employee costs and other income which was unusually high in the current quarter. They want to understand if these figures represent a peak or a trend towards future growth/stability. Answer summary. Employee costs will likely remain stable unless significant changes occur business as usual. Other income is primarily due to strong cash flow and treasury investments. This positive trend could continue with potentially even greater returns. However, it represents only a small part of overall revenue. Key takeaways. Employee costs likely to stay consistent barring unforeseen circumstances. Other income, driven by robust cash flow and treasury investment gains, potential for continued growth exists. Overall revenue growth. Management expects stability in employee costs and further improvement in other income. Future outlook. Positive outlook for both employee costs and other income, though not guaranteed. Q&A analysis. Question. The investor asks about the impact on cash flow due to a slight increase in debtor days, the amount of time customers take to pay their bills compared to previous quarters. Answer. Management confirms that an improvement in creditor days time taken by suppliers for payment contributed positively to cash flow. They also mentioned that they were able to improve debtor days in the third quarter. Key takeaways. Debtor days improved in quarter 3. Creditor days remained efficient. Cash flow benefited from improvements in both debtor and creditor days.